In the span of 48 hours, a market that was trading as if gravity had been canceled snapped so hard it rewrote the mood of an entire sector. 10 on February 2nd. That is not a normal pullback. That is the kind of move people say can't happen in a modern, liquid, institutionally watched market. Yet it happened anyway, and it happened fast. One session included reports of an intraday tumble as deep as 36%, the kind of number that makes traders reread their screens, because it breaks normal expectations about what a major market is supposed to do. And here's the part that changes how this should be understood. The most important information in a move like this is never in the candle. It's in the mechanics. It's in the collateral rules that tighten at the worst moment. It's in the positioning that looks stable right up until it isn't. It's in the quiet institutional adjustments that happen before retail even notices there's a problem. The market doesn't just fall. It gets pushed through trapdoors built into the system, and those trapdoors only become visible when volatility arrives. What I'm about to lay out is not a prediction, and it's not a pep talk. It's a forensic walkthrough of how a metal can be simultaneously in demand and for sale, how physical appetite can coexist with paper stress, and why the 80 to 75 zone isn't a random number on a chart. It's a battlefield where the next phase of this story either stabilizes into consolidation or fractures into another leg that forces more participants to do what they swore they'd never do. Welcome to Channel Name. This is where we decode what matters before it becomes obvious. If you like analysis that sticks to the data, that follows the plumbing and the incentives, and that refuses to confuse noise with signal, you're in the right place. And if you've been listening like that wise elder in your life who always seems calm because they've seen the pattern before, you already know the value of staying close when the crowd starts shouting. Drop a comment with where you're watching from, because the way different regions experience this market often explains the next chapter. Now let's talk about what actually happened. Silver didn't merely drift lower. Tian. By February 2nd, the path between those numbers was not smooth. It was violent, gappy, and reflexive, the kind of motion that suggests forced activity rather than patient decision-making. At the same time, the narrative backdrop shifted sharply. A key catalyst that hit sentiment and rates expectations was the announcement that President Trump nominated Kevin Warsh for Federal Reserve Chair, a move widely interpreted as potentially changing the direction of rate policy and the dollar's trajectory. When the macro story changes quickly, commodities don't just reprice on fundamentals, they reprice on balance sheets. A parabolic move invites leverage, and leverage is always calm right up until it meets a margin clerk. That's why these collapses often look like a mystery from the outside. The answer is that sometimes they aren't choosing to sell, they're being made to sell by the math of collateral. This isn't just a US story either. In India, silver futures saw a headline plunge of about 17% in a single day, with reports framing the fall as roughly 68,000 rupees. Those are numbers that rattle confidence because they translate the abstract into the personal. That's rent, inventory budgets, wedding purchases, working capital. When a metal moves like that, it stops being a chart and becomes a shock to real cash flow. So what's the central mystery? It's this. You can have strong stories about physical demand, especially in parts of Asia, and yet still see a cascading sell-off in the widely traded financial instruments that set the reference price. And that is the dislocation. One side of the world can be pulling metal, premiums can rise in local markets, and the global benchmark can still be falling like an elevator. Well, that contradiction isn't a conspiracy. It's the result of structure. And structure is where the story gets real. To see why, we have to step back and look at history. Because silver has run this playbook before. In 1980, silver experienced a dramatic rise tied to speculative fervor and concentrated positioning. And the aftermath wasn't a gentle return to normal. It was a collapse that punished leverage and taught a generation what liquidation really means. In 2011, silver ran hard again. And then it snapped in a way that felt sudden to people who only watched the price, but it made sense to those who watched margin dynamics and crowded positioning. And in the 2020 to 2021 window, silver's volatility reminded markets that even in an era of instant information, the same mechanical forces still apply. Leverage builds quickly when price rises. Quickly, and leverage unwinds even faster when the system tightens. The point of these parallels isn't to say 2026 equals 1980 or 2011 in magnitude. The point is that the sequence repeats. Acceleration, crowded positioning, a catalyst that changes funding conditions, then a mechanical unwind amplified by collateral and risk limits. The chart looks like a motion. The underlying process is arithmetic. Now bring that lens to the present. On January 13th, 2026, CME shifted precious metals margin methodology to a percentage of notional framework. That sounds technical, and it is, but it has a simple effect. When prices rise, margin requirements can rise with them more directly. In a calm market, that might look like a prudent adjustment. In a parabolic market, it can become a lever that tightens at the worst time. Participants who were comfortable with a certain level of leverage can find that the same position suddenly requires materially more collateral simply because the notional value has expanded. And this is where the timing matters. A market that was sprinting upward into late January was now living under a framework that could demand more collateral as notional values ballooned. Then volatility spiked and the macro story shifted. If you've ever watched a crowded theater where someone suddenly yells fire, you know what happens next. People don't leave in an orderly way, exits clog, and those closest to the doors get out first. In markets, the equivalent of being close to the door is having liquidity, having diversified funding, and having the ability to post collateral without selling the thing that's collapsing. So who was positioned, and what do we know about it? 2,000, the prior reading. That may not sound dramatic on its own, but it signals cooling in speculative appetite, right as volatility was picking up. In a fragile moment, even modest de-risking can become a trigger because it hits when liquidity is already thinning, and it hits when risk departments are simultaneously tightening limits. This is the institutional movement piece. It's not a single bank deciding to attack a metal. It's a web of risk departments, clearing rules, and position managers reacting to new conditions at the same time. When collateral rules change, when implied volatility rises, when the dollar narrative shifts, their models flash the same colors. Reduce exposure, tighten limits, raise haircuts, demand more collateral. The individual actions add up to a coordinated outcome without requiring a coordinated meeting. Now let's talk about the dislocation, because this is what most people miss. A headline can say physical demand is strong, or even extremely strong, and it can be true. Reports out of China have talked about elevated premiums in local markets, with descriptions suggesting a premium that was unusually large versus London benchmarks. When physical premiums rise, that usually signals tightness, localized demand, or both. And yet the benchmark price can fall if the marginal transaction is happening in paper markets, where participants are reducing exposure fast, not negotiating for delivery slowly. Think of it like a crowded auction, where the loudest bids come from a few players using borrowed money. If their lender changes the rules mid-auction, those loud bidders can vanish instantly. The item might still be desirable. People might still want it. But if the marginal price setter was the leveraged bidder who just got cut off, the price can drop. Even if demand exists, because the price is set by who is most aggressive at the margin, not by who is most sincere. That's paper versus physical in plain terms. Physical markets move with logistics, premiums, and delivery constraints. Paper markets move with collateral, risk limits, and the need to close positions quickly. When those systems collide, you get a price that looks wrong relative to the stories people tell. But the price isn't wrong. It's reflecting which arena is currently dictating the benchmark. Now layer geography on top. East versus west flows can create their own divergences. If Asian buyers are pulling metal, they can bid up local premiums. If Western funds are de-risking paper exposure, they can pressure futures and ETFs. Both can happen at the same time. And the spread between them can widen until arbitrage, logistics, and confidence pull it back. But that narrowing doesn't happen instantly, and it doesn't happen without friction. So what is the evidence that this wasn't just normal profit taking? Start with the sheer magnitude and speed. 10 is roughly a $40 move. In percentage terms, that's enormous for a major traded metal in days. Then consider the reported 36% intraday depth during the shock session. Intraday extremes of that scale are not the signature of patient selling. They are the signature of gaps, stop cascades, and forced liquidation. They tend to occur when market makers widen spreads, when liquidity pockets vanish, and when participants are trying to reduce risk, not express a new opinion. Add India's 17% daily plunge in futures, described alongside that 68,000 rupee figure. That shows the move wasn't confined to one venue. It echoed across markets and time zones, pulling liquidity and confidence with it. When a move is global, it usually indicates that the driver is global as well. Funding conditions, macro expectations, and the shared infrastructure of derivatives markets. Now look at the rulebook again. A percentage of notional margin regime means that rising prices can automatically demand more collateral. That can turn an uptrend into a trap. As the price rises, leveraged participants get squeezed on collateral even before the price turns. Then when the price finally turns, they're squeezed again because their equity declines while collateral demands remain intense. That's why tops in leveraged markets often feel like they come out of nowhere. The collapse begins while the crowd is still celebrating the ascent. This is the mechanism, and it's worth making it simple. Imagine you're carrying boxes up a staircase. The higher you climb, the more winded you get. Now imagine someone quietly adds weight to each box as you climb because the boxes are worth more higher up. That's the percentage of notional effect. You don't feel it at first, but at some point you hit a step where your balance falters, and when you wobble, the boxes shift, and suddenly you're not climbing anymore. You're trying not to fall. If you drop the boxes to save yourself, everyone below you feels the impact. So what does this mean going forward, especially with the title framing the next stop as the 8 Dig to 75 battle? It means this zone matters because it's where different categories of participants tend to re-engage. Some participants see it as a place where forced sellers are finally exhausted. Others see it as a place where risk models still demand reduced exposure until volatility settles. And still others see it as a place where the physical and paper divergence becomes so visible that it forces conversations about delivery, inventory, and the credibility of benchmarks. Historically, when silver breaks a key support after a parabolic rise, one of two things tends to happen next. In the conservative path, the market stabilizes into a choppy range, while volatility bleeds out, positions reset, and the macro narrative clarifies. That looks boring compared to the crash, but it's often where the next trend is built. In the moderate path, the market probes lower, testing whether the move was merely a flush or a deeper repricing of expectations. That usually involves failed rallies, sharp reversals, and repeated tests of support as participants decide whether the new regime is temporary or durable. And in the aggressive path, the market experiences another air pocket, not because demand disappears, but because the system is still clearing the leverage that accumulated at the top. Notice what all three paths have in common. Both. They are driven by whether funding conditions and volatility allow participants to hold positions without being forced to change them. That's why, if you're watching this story unfold, the key indicators are not emotional narratives. They are measures of volatility, changes in margin frameworks, shifts in positioning, and the behavior of spreads and premiums between physical hubs and paper benchmarks. If volatility continues to stay elevated, historically it has tended to keep risk limits tight and encourage smaller position sizes. If volatility declines, historically that has allowed liquidity to rebuild and has reduced the likelihood of forced selling. If positioning continues to unwind, it can relieve pressure over time, but it can also keep the market vulnerable if liquidity remains thin. And if physical premiums stay unusually high while paper remains weak, that gap can become a signal that the tension between the two arenas is still unresolved. This is also where expert contradictions show up and why they matter. In every major metal move, you will hear confident claims that the price must do one thing because of a single factor. But the market is not a single factor, it's a system. The same person can be right about physical demand and wrong about paper price action, because they are talking about different layers of the same market. Another person can be right about macro rates and wrong about local premiums. Contradictions don't mean someone is lying. They mean the market is layered, and different layers can dominate at different times. Now let's connect the dots on the institutional side without turning it into a cartoon. When a nominee like Kevin Warsh becomes part of the Fed chair conversation, the market doesn't wait for policy to actually change. It prices the possibility. It reprices interest rate expectations. It reprices the dollar. It reprices the discount rate that sits behind every leveraged position. For metals, that can translate into a rapid reassessment of what kind of environment is coming next. A tightening narrative, or even the perception of one, tends to strengthen the dollar and raise real rate expectations, both of which can pressure precious metals through the funding channel even if long-term demand stories remain intact. Combine that with a margin methodology that responds to notional value, and you get an environment where the cost of holding a position rises. At the same time, the confidence behind the trend is shaken. That is a recipe for disorder. And once disorder begins, it tends to feed on itself because stops trigger, volatility rises, spreads widen, and liquidity steps back. Markets are social systems with math underneath, and when the math changes, the social behavior changes too. So where does that leave the 80 to 75 battle? It is not about being brave. It's about being solvent. It's about whether the marginal seller is still forced, or whether selling becomes a choice again. When selling is forced, price can overshoot any narrative. When selling becomes a choice, price tends to respond more to fundamentals, premiums, and longer-term positioning. This is the part no one is discussing loudly enough. The violence of the drop can create the illusion that the move is finished, when in reality the system is still digesting collateral changes and risk resets. After a major liquidation, there's often a period where markets look calm on the surface, but the internal plumbing is still adjusting. That's why rebounds can be sharp and then fade. That's why support levels can break, recover, and break again. The market is not just searching for a price. It's searching for a stable configuration of who holds risk, under what rules, with what funding. If you want to watch this with clarity, watch for signs that forced activity is fading. Watch whether daily ranges shrink. Watch whether sharp rallies hold rather than instantly retracing. Watch whether spreads between venues normalize. Watch whether the narrative around physical premiums converges with the behavior of paper pricing. And watch whether positioning metrics continue to decline or stabilize, because stabilization can signal that the crowded exit is less crowded. One more layer of evidence sits in how quickly sentiment flipped from certainty to caution. Only days before the break, commentary treated the uptrend as self-justifying. Higher prices were framed as proof of scarcity, and scarcity was framed as proof that higher prices were inevitable. Then, a single volatility spike turned the logic inside out. In leveraged markets, inevitability is often just a synonym for crowding. Crowding leaves fingerprints. It shows up when rallies stop pausing and start leaping. It shows up when pullbacks become shallow enough that risk managers stop respecting them. It shows up when traders talk more about targets than about risk limits. It shows up when a market begins to trade like a momentum instrument rather than a commodity with industrial use, inventory, and logistics. Silver did that into late January, and the snapback was the cost of that transformation. It also shows up in the language of exchanges and clearing. When an exchange adjusts methodology, it is signaling that it expects a different regime. A percentage of notional framework is, in effect, an admission that prices and volatility can rise enough to make fixed assumptions unsafe. That is not bullish or bearish. It is structural. But structure determines who can stay in the game when the mood changes. If this sounds abstract, consider the chain reaction. A drop triggers margin calls. Margin calls trigger liquidation. Liquidation widens spreads. Wider spreads increase volatility. Higher volatility raises risk models required capital. That reduces market making. Less market making means less liquidity. Less liquidity makes each sell order hit harder, which triggers more margin calls. It is a feedback loop, and it can run until a new balance is found. The loop breaks when forced sellers finish, when liquidity returns, or when prices reach levels where buyers insist on metal, not just exposure. Sometimes it breaks because volatility collapses. Sometimes it breaks because the macro narrative stabilizes. Sometimes it breaks because the pain resets positioning and the market can breathe again. In past cycles, that breathing phase is where the next move is decided, long before headlines catch up fully again. Now, zoom out one more time, because the big lesson here is about information and timing. Institutions move first, not because they are smarter in some mystical way, but because their mandate forces them to monitor collateral, funding, and volatility continuously. They don't need a headline to act. Their models act when thresholds break. Retail often moves last because retail is trained to watch price and story, not plumbing and rules. That is the divide. It is not about intelligence. It is about what you pay attention to. The information gap becomes a positioning gap. And the positioning gap becomes a wealth gap because the first movers get liquidity and the last movers get slippage. This is not moral. It's mechanical. Ask what changed in collateral expectations. Ask what changed in macro narrative. Ask how quickly leverage accumulated and how quickly it was forced to unwind. That's where the real answers live. This is Channel Name, where we decode what matters before its headlines. If this connected dots you hadn't lined up yet, you know what to do. Because the question isn't whether markets can move violently. You've just watched that happen. The question is whether you can read the signals that show when a move is shifting from a story into a stress test, and whether you'll recognize the next trapdoor before it opens.